This is video 1 of 3, covering pages 1 to 5 of the Chapter 2 class notes. Chapter 2 reviews several cost concepts, cost classifications and terms, and it covers cost behaviors. In general, this chapter will go over how resources are used and the costs associated with that use, how those costs flow to products or how they're assigned to the product units that they're helping to produce, how we report that use of resources or those costs in the financial statements. It will define several types of costs and cost classifications, and we'll discuss cost behaviors, as in variable or fixed, or different variations thereof. And we'll talk about the flow of cost components to products in cost accounting, and we'll mention some about financial accounting. The first, this chapter is hyper focused on cost. So first, we begin by defining what a cost is. A cost is defined as a sacrifice of resources. So we're giving up something to get something else. It is a broad term. It is a sacrifice of resources regardless of when it occurred and how we recorded it. It doesn't matter if it was recorded as an asset or expense initially. The cost itself is just the fact that we had to give up something. We had to pay something. We had to give up something else that was valuable, some other resource. A cost is just what we gave up to get something else. The focus of cost accounting is truly cost. Now, costs are related to expenses. In fact, all expenses reflect cost, but not all costs are expenses, as in the definition here. It could have initially been recorded as an asset. I gave up something, but that something is going to provide some future benefit that I'm not used up yet. That future benefit reflects an asset. It doesn't matter whether it's recorded as an asset or an expense. The cost is just what we gave up. Expense is a accounting specific concept and term. An expense reflects costs associated with the revenues we generated in a given period. So an expense is the cost of generating revenues in this period. So a cost will be an expense if we used that cost, or if that cost helped me generate revenues in this period. If I've not yet used up what I received for that cost, we would have it recorded as an asset because it remains for future benefit, future consumption. So think about something like prepaid insurance. It cost me money to buy my insurance policy, but say that I paid for it in advance. I've not yet used up any of the insurance benefit. I still have future coverage. That cost isn't an expense yet. I've not used it up yet. It still exists for future benefits, so it's an asset. So all costs or all expenses are costs, but not all costs are expenses. There are two basic types of cost. Recall here, our focus in cost accounting is going to be cost. I just want you to know that while we're going through this, all costs are not expenses, so just bear that in mind. Don't use the two interchangeably. We got two key categories of cost, and I do truly mean cost here. There are outlay costs. Basically, I, at some point, am going to have to pay something. I'm going to have to pay cash to someone. It could be in the past, it could be in the present, it could be in the future. But at some point, I'm giving up cash. So say that I was looking at decisions and I was trying to analyze the cost of pursuing a college education. Outlay costs associated with deciding to pursue a college education would include things like tuition, fees for books, fees for my classes themselves or for college, parking fees or so. That's an outlay cost. That is something that requires a cash payment at some point in time. Then we have opportunity cost. Opportunity costs can be confusing because it's not like they're costs that you write a check out for. They're cost of something else that you gave up. They're the cost of a missed opportunity. Or you say a benefit lost because you chose one thing over another. It's the cost associated with some opportunity I did not take. So, for example, if I were trying to choose between taking a summer class or working more hours during the summer, if I chose to take the class, the opportunity cost of choosing that is I didn't get to earn the extra wages from that summer or the extra summer hours. So the opportunity cost is the lost wages for extra hours. I missed the opportunity to make that money because I chose the other. Outlay costs are generally pretty easy to estimate, to understand, to even project because they require cash payments. It's normally pretty tangible, pretty identifiable. Opportunity costs, though, these costs of missed opportunities, they're difficult to assess because sometimes it's difficult to know what all our opportunities even are, much less what we're giving up. They're easy to overlook, but they're still really relevant. So, and they're difficult to pin down. So, extra time and consideration should be given to making sure you understand the opportunity costs of your decisions. Okay, now, how are costs presented in the financial statements? So, this obviously is related a little bit, it's talking about financial statements. We're talking about financial accounting, how these costs kind of translate into financial accounting. So, it's to a large degree how they're reflected as expenses in financial statements. How they're presented depends upon the type of company you're looking at. So for service organizations, they're not selling a product, they're selling a service. It's people out there doing some kind of like labor, some kind of service for their customers. The expenses, they expense cost of the services. So any kind of cost associated with them providing the services to their customers is expensed via cost of services sold. These are the costs that were billed to customers for the services sold in that period. This would include any labor costs associated with billable hours on those jobs that were sold. It would also include any other kind of costs of providing services that were directly billed to that customer. That all gets lumped in cost of services sold. If costs, we got some costs that are maybe associated that are expenses in that period, but they're not billed to customers, customer services. Those more general costs get expensed via SG&A or selling general and admin expenses. Your textbook likes to call this marketing and admin expense. I prefer SG&A, so I will use that term a lot through here. They're interchangeable though. You could abbreviate that as M&A, but they're interchangeable. They're talking about the same exact thing. So just note that throughout the note packet. So SG&A is just everything else that wasn't billed directly to customers. For retailers and wholesalers, or basically merchandisers, people that buy a product from someone else and then sell it themselves, so like think Walmart, Amazon, whatnot, they expense the cost of their inventory. When they sell that inventory, the costs associated with them buying and acquiring that inventory is expense via cost of goods sold. You'll see that for both merchandisers and manufacturers later. Merchandisers assign costs to their inventory or the products they purchase. They assign costs relating to the actual purchase price of the products, and they take the inventory or the transportation in, basically what it takes to ship the inventory, what they have to pay to ship inventory to themselves to get the inventory they bought. Those costs are assigned to their inventory. They record that initially as inventory, which is an asset. Basically, all the costs that they incur up until the point that they get that inventory onto their store shelves, everything from the purchase price they pay to any kind of duties they have to pay to import it to the cost to them for shipping it to them, all of those costs up until the point it gets on the store shelf, they're assigned to inventory. And those costs assigned to that inventory is expensed when the inventory is sold. They may internally do something called a cost of goods sold statement to compute cost of goods sold that's reported on the income statement. So they may use that to help them calculate their cost of goods sold. For them, any other costs related to selling the inventory, so things like advertising, salesmen's salaries, commissions, those costs of selling goods and the costs of like the overall administration of the company, like salaries of the staff at the corporate headquarters or office related expenses, those things all fall under SG&A. If it isn't part of the cost to get it onto the store shelf and ready to sell, it's SG&A. So let's work through this example. You have Office Plus. They are retailers selling office equipment. They have the following information regarding their activities and inventories for 2024. Here, I'm asked to do an income statement. So remember, an income statement fundamentally represents the net income equation, which is revenues minus expenses. So I'm looking for revenues and expenses. Obviously, sales is a revenue, $3,225,000. Just going to say K. Then I need expenses. Typically, I'm going to subtract cost of goods sold directly after sales. That's the first expense to get this high level income measure called gross margin, or sometimes you'll see it called gross profit. Either one is fine here for me. The only other kind of expense I would have then be SG&A, which is subtracted after gross margin. So that I can calculate net income. Obviously, I need cost of goods sold. So I can do the cost of goods sold statement for Office Plus. I've got all these inventory related accounts. The key equations here that are underlying that statement for merchandisers is the calculation of goods available for sale, and cost of goods sold. So like the ultimate goal here is to calculate cost of goods sold. To calculate the cost of goods sold, I need to know how much is missing from my ending inventory. To figure that out, I start here. I know that I initially had $300,000 in inventory. During the period, I bought 1 million. $1,830,000 in new inventory. So that cost gets assigned to inventory. Also, the cost to get it to me, the transportation in of 90,000 is part of inventory. So the collective total that I added to inventory during the period $1,830,000 plus 90, $1,920,000. So I have what I started with plus all the new things that I added to that to give me all that I had that I could have sold during the period, all that I had available for sale during the period. Basically, the theoretical maximum of what I could have sold. Altogether, I had $2,220,000 in inventory during the period. Of that $2,220,000, I only have $445,000 of that left. If I don't have it still, we assume that I don't have it because I sold it. So whatever is missing is what I sold. I had $2,220,000. How much of it's missing? $2,220,000 minus the $445,000 I still have. I'm missing $1,775,000 worth of that inventory. I assume that it's missing because I sold it. That would be my cost of goods sold. It's an expense. So this is a high-level income measure. Any kind of income measure is going to have a revenue minus an expense. Cost of goods sold is an expense. Sales is a revenue. $3,225,000 minus $1,775,000. $1,450,000 in gross margin or gross profit. To calculate, I think they actually call this operating profit. Calculate total operating profit here. I had gross margin, $1,450,000. That was sales minus cost of goods sold. I just need to remove the last of the expenses. The SG&A, $1,450,000 minus $825,000, $625,000. That was for a merchandiser, someone who buys inventory from someone else to sell it to customers. Next, we talk about manufacturers. A lot of the accounts they use are really similar to the ones used for merchandisers. They have inventory that they're selling to. A key difference, though, is that they make their own inventory. So they have to account for and track inventory costs throughout the production process. So ultimately, just like the merchandisers, they report the expenses associated with their inventory as cost of goods sold. And they use SG&A to report any expenses or costs that are not inventory related. So basically, they're selling general and admin expenses, same as for merchandisers. The key difference is that they make their inventory, so there's a lot of complexity of costs associated with all those different stages of inventory, associated with the different stages of the production process. So manufacturers have to track and assign materials, labor, overhead costs to the products that they are making throughout the production process. Manufacturers, actually, I would say this is true for both manufacturers and merchandisers, but they're distinguishing costs based on their financial accounting treatment. Um, they got product costs and they got period cost. Product cost is the word for the cost of making or producing or manufacturing the products. Those are manufacturing costs. Non-manufacturing are basically just SG&A. That's pretty well synonymous with SG&A. By accounting treatment, we mean that product cost, the cost of the product. That product means it's the cost of the inventory. Product and inventory are synonymous. If we're saying that we're accounting for something like a product cost, we're saying that we initially recorded as inventory, and inventory is only expensed when that inventory is sold. The cost of inventory only expensed when inventory is sold. Period costs, on the other hand, though, these are just all the other SG&A. Those are expensed in the period they're incurred. So they don't get capitalized versus inventory. They're just expensed when they're incurred. Those are your non-manufacturing costs, so costs outside of making a product, getting ready to be sold. It's basically just SG&A. There are a lot of other cost classifications and inventory types, inventory accounts, specific calculations for manufacturers, but we're still talking about inventory accounts. And inventory is still an asset. There's still that same basic rationale for their accounting. We'll talk a lot about these different cost classifications in the next few sections, though. So first, manufacturers. There's 3 different product costs: direct materials, direct labor, and overhead. Sometimes we split those up into different cost classifications themselves. So we'll talk about direct and indirect product cost. So we're talking about how to split those 3 costs: direct material, direct labor, and overhead up. We'll classify those as either direct or indirect. Whether or not one of those costs is direct or indirect, is determined based on whether the cost can be traced back to the product. At least, can I cost effectively trace it back? We don't trace it at all costs, but can I cost effectively link that cost to that product? If I can trace it, it's direct. Note, it's direct. 2 of those product costs have direct literally in the name: direct materials, direct labor. Those are direct costs. So it's determined based on whether it can be cost effectively traced back to the cost object. If it can be traced, the cost is direct. Direct materials, direct labor. So for a car manufacturer, engines, seats, radios, those are direct materials. I know which car got which engine, what type of seats, what the cost for those were, what the radio was. And then direct labor, the wages, benefits of those people that actually make the car. That's direct labor. I know exactly, so like assembly lines, we know exactly how much time they're supposed to put into every single car that's passing down that production line, and we know how much we pay them. We could easily trace those costs back to the product. In that case, the car. If I can't trace it back, that is indirect. Note, I've already used materials and labor here. The cost that I can't trace back is overhead. Overhead equals indirect. Indirect equals overhead. There are 3 basic types or subclasses of overhead. You got indirect labor, indirect materials. Indirect labor is basically wages, benefits, compensation for those who are working in a factory but they do not actually create the product themselves. They're not working directly on the product. They're working to support production. Maybe they're supervisors and they help oversee things, make sure things are going okay. Maybe they're support staff, maintenance staff, janitorial staff. Like their work helps the plant run, but they're not out there directly working on any one car. That's indirect labor. That's pretty well true for any kind of supervisor or any person in a support role in the factory. They help the plant run, but they do so indirectly. Then we have indirect materials. These are materials or supplies that we can't cost effectively trace back to the individual car. Normally, these things are going to be small, really cheap or inexpensive, maybe difficult to trace with great accuracy. Remember, it's about whether they can be cost effectively traced. So, would it be worth my time to have an employee who occasionally has to use glue or tacks to like hold up um, the material, the headliners in the car? Would it be cost effective to have them write down how many milliliters, to track how many milliliters they used on a car and to go somewhere and record the exact milliliters used on that car when the glue itself costs like fractions of a penny? No, it's not worth the extra time and labor that would take. I don't link it at all cost. If it's not worth my time to trace it, it's not traced and it's just classified as indirect. So things like staples, glue, like finishing nails, small, inconsequential, super cheap, not really super easy to trace or convenient to track, indirect materials. Other plant-wide overhead then, this is just general other um, costs that are for the benefit of the entire plant. So say things like my lights, um, exactly how much of the power is going into helping produce one car, the lights shine on them all. Difficult to trace that to anyone. It's just a general overall plant cost. Those are also considered overhead. If it's a cost operating the plant, but it's not really something that I can directly tie to like one individual product unit, it's just general plant wide. That's also true for like things like insurance on the factory building. Oftentimes, I'll also add in there plant equipment or machinery depreciation. Okay, so that's one way of classifying those product costs. Remember, product costs, three of them: direct material, direct labor, overhead. Another way of classifying product costs, so once again, trying to split or classify those three costs there in one of these categories, are prime and conversion costs. When we say prime costs, we essentially just mean direct costs. They're costs that are directly linked to production. So they're direct materials and direct labor. One's direct in the name, just another term for direct cost. Then we have conversion costs, the costs associated with taking raw materials and turning them into the final product. Note here, it kind of assumes we have materials. So that kind of implicitly means it doesn't include direct materials. It assumes I've already got those. It's the cost of taking those materials and turning them into something else. To turn them into the final product, if I've got just a stack of car parts, what do I need to change that stack of car parts into an actual functioning car that I can sell? Well, I probably need somebody who knows how to put together a car. I need direct labor. And I also probably need a place to build it, the tools to build it, other people's help to help me like plan out things in building it. I need overhead. Basically, it's everything but direct materials because it assumes you've got them. That's what you're converting. You need the other things. Note that direct labor, a component of both of them. They're overlapping. Um, Sometimes companies focus on one of these over the other. They might be concerned about calculating conversion costs, and some of them might be concerned with calculating prime costs. Prime costs are more often a focus um, when those direct costs, like direct materials or direct labor, are a particularly high proportion of their total costs. Conversion costs can be the focus, though, when one of those costs, direct labor or overhead costs, are really high, especially if they do not have a lot of control over their direct material costs, which is common, especially if like the material that you're using is a commodity where it's about like this overall market demand. You really can't sway that a lot. So in that case, you focus more on the costs that are controllable, like conversion costs. What should any one specific firm focus on? That's going to be a case by case determination. Typically, you're looking at the costs that are higher, the ones that have greater magnitude of impact. And there's also a preference to focus on costs that you have control over. Because if you don't have control over it, there's very little you can do about those costs. You want to look at what you can control and what has the biggest impact. We've talked about those classifications for product costs. Next, we focus on classifying period costs. Remember, those non-manufacturing or non-product or period costs basically are comprised of SG&A or marketing and admin if you're going by this textbook's language. There are two big components then of those. You can break them down by selling and then general and admin or G&A or marketing and admin. Selling costs are all the costs to help me sell the product. So things like advertising, shipping costs, salesperson salaries or commissions, those kind of costs. They help me sell the product or they're part of selling the product. In general, and admin is basically just those overall costs, like the entirety of the organization. Basically, these are costs that often happen like in an office, or maybe you would think of them happening like in a corporate headquarters. Basically, these are not costs that are happening inside the plant, though. These are costs happening in like the general overall offices. It's just cost managing the entirety of the organization. So, like executive salaries, legal, accounting expenses, office rent, office equipment depreciation, things that are happening in the office. That's general and admin. These are not part of making the product. They're not happening in a production plant. They're costs of either moving it or just in general running the entirety of the organization. So think about like Apple. Apple's got manufacturing plants. The things happening in those manufacturing plants are production related, but they also have a corporate headquarters that makes decisions for the entirety of Apple's company, all of which is not necessarily manufacturing. Financial accounting treats those costs like period costs, the non-manufacturing costs. But sometimes cost accounting will want to do calculations that assign those costs to products, especially when some of those costs are really linked to each product unit, like the cost of selling some particular product, including like things like the salesperson pay or commissions, certain related advertising costs, or maybe even other variable selling costs like shipping costs. Sometimes in cost accounting, they want to really link the cost to the product, so they may still assign those period costs to the products. That is only for the sake of cost accounting. For financial accounting, they're still treated like period costs. Okay, so let's talk next about cost allocation. Direct material, direct labor, those are pretty easy to tie to the product. I mean, they're already kind of traceable to the product units by definition. Overhead or indirect, how do we tie that to the product? It's not really directly related. I can't link it to specific products. We do that by allocating the cost. Basically, cost allocation refers to how we take overhead costs and assign them to the product units or the cost objects they're related to. When I say cost object here, we mean what products or processes are we assigning or allocating costs to. For us, typically, we're focused on assigning them to products, but you can assign them to processes or other cost objects as well. Cost pool here just refers to the cost that we're assigning or allocating. It is the cost we have to assign. Cost object is what we're assigning those costs to. We assign costs based on some cost allocation rule. We basically devise some method or process that we use to assign or allocate costs to the cost object with. That is totally dependent on preferences, needs, like what makes sense in certain situations. It's case by case. It's case by case determination sometimes. So let's allocate. This is best explained by just allocating costs by doing an example problem. So let's say we have Rockford Company. They've got two divisions, East and West. In 2025, they report information system costs of $1 million. These are indirect product costs or overhead. So I want to allocate this $1 million. They specifically want to allocate them to the East and West divisions. So it's how I'm going to split those up between those two divisions. So how should we assign those costs, or how should we allocate it? We could split it equally. We could just decide to split it evenly. 500 there, 500 to West. One of the criticisms of that can be that if like one of them is much larger or much smaller than the other, so say that West is much smaller than East. If West is much smaller, then why should they bear an equal portion as East? They could split it based on their size, since the West is much smaller. Say that we measure size in terms of like their individual revenues at the division level. But East could come back and say something like, or West could come back and say something like, East could come back and say that they use those systems a lot less than the West does. So if they're using it less, but they're larger, why should they bear more of the cost when they generated less of the cost? Obviously, there's a lot of room for disagreement relating to how these costs are allocated. That's pretty typical. Ultimately, this is a judgment call. Accountants, managers are going to use their knowledge of the company and exercise their professional judgment to decide how best to allocate costs, ideally. So in this case, let's assume that the accountant decided to allocate costs based on division size, the percent of revenues that are attributed to each division. So what percent of revenues did East make up? What percent of revenues did the West make up? Overall, 80 plus 20, there was $100,000 in total revenues. So the proportion of revenues that were earned by East be 80,000 that they made up, divided by the 100,000 total. So 80% for the West at 20 of 100,000. So they comprised 0.2, or you could say 20% of total revenues. So that is how much of the information systems cost I'll assign to East. This is how much the information systems cost I'll assign to West. So I'm going to split out that $1 million based off of these allocation proportions. So I have $1 million. I'm going to split up for both of them. It's 80% for East, 20% for West, 1 million times 0.8, 800,000, 1 million times 0.2, 200,000 to West, 800,000 to East. In total, I should have allocated out all 100,000. 800 plus 200 means that I have indeed allocated out $1 million in information systems cost. That would be how I would assign those costs to those divisions, given that stated rule. Okay, that is the end of video 1. We'll pick back up with video 2 at the top of page